My name is Ruben Bock. I am the Portfolio Manager for Atticus, which is the investment management arm for AFPG. We are providing you these video updates to keep you better informed with markets and show what it means for investors. Today we are looking at our portfolios to show you how we're invested and how we are different. Let's start with the Atticus investment approach. We start with a global opportunity set. We analyse literally over 1,000 investment managers. Then we narrow in on the best of breed across the most promising asset classes. The result is a portfolio filled with only the highest quality investments. Let's look at how we apply this approach to one of the most lucrative sectors, the Australian emerging companies sector. As an investor, the emerging company sector is one sector that you want to get exposure to. This is where you can find some amazing growth stories. Think realestate.com.au and A2 Milk. Both examples where investors made multiples on their investment. But this is also an area of high risk. This chart shows the return from the 560 stocks that made up the Australian Small Companies Index over the last 10 years. The green zone shows the stocks that went up. There are about 50 stocks in this green zone that went up by more than 100%. The grey zone shows the number of stocks that basically did nothing over this 10-year period. There are about 180 stocks in this zone. The red zone shows the number of stocks that lost money for investors. There are about 180 stocks in this red zone, and about 120 of these stocks fell by 80% or more. What this chart is saying, that the number of stocks where shareholders lost money far outnumbered the number of companies where shareholders made money by a ratio of 2 to 1. That is, for every stock that went up, there were 2 that went down. What this means is that if you are going to make money, you need to work your way past a lot of junk to get to the higher quality companies. If you invested in a passive index fund for this segment of the market, your return was dragged down by having twice as many losers as there were winners. For this reason, we employ 2 active managers who are specialist stock pickers in this space. We reviewed almost 150 specialist managers in this emerging company sector and have narrowed in on the 2 of the best for our portfolios. Both of our managers can boast a track record well ahead of their peers and the index, and do so with much less risk. Being able to invest in the emerging Australian company sector is a point of difference between us and some of the larger super funds. This is primarily a function of our size. Atticus are investing less than $1 billion, whereas some of the larger industry funds are investing $100 billion. The more money you invest, the harder it becomes to move that money from one investment to the next. This is especially hard when you are dealing in small stocks with small market values. The second key point of difference is our exposure to the emerging market space. When I say emerging markets, think China, India, Indonesia, etc. It is no secret that the emerging market economies are expected to be the main source of global growth over the coming decades. In fact, according to a report from PwC, the emerging market economies will dominate the list of largest global economies by the year 2050. This chart ranks each country in terms of GDP for both the year 2016 and the year 2050. It is also colour-coded. The red lines are the emerging market countries, the grey lines are the developed economies. As at 2016, the largest countries were China, USA, India, Japan and Germany. By 2050, the US will be the only developed country in the top 5, with Japan and Germany falling out and being replaced with Indonesia and Brazil. Australia, for that matter, is expected to fall from the 19th largest economy to the 28th. I have highlighted Australia in yellow. Given the superior growth outlook, you would expect that emerging market shares would be valued more highly than, say, the Australian market. What we observe is in fact the opposite. The valuations for emerging market shares are currently at a steep discount relative to all other markets. This chart is showing the valuation level of emerging market shares relative to other regions. Emerging market shares are shown in the yellow line in the top half of this chart, whilst Australia, the USA and global valuations are the green, maroon and blue lines. The top half of that chart shows that emerging market shares are typically valued at a discount, but at quite a wide discount currently. The bottom half of this chart shows the earnings picture for these regions. Emerging markets is shown in yellow again, and that earnings level has far outpaced the other regions of USA, Australia and global regions. So our take out of this is that over the long term, the emerging market proposition for investors looks really strong. This is because you're getting a stronger growth environment for a cheaper price. This view is reflected in our portfolios with an overweight position in emerging market shares. For investors who hold a passive index fund, your direct exposure to emerging markets might be 1%. We think investors should hold a much stronger position to these markets. Our best of breed managers in the emerging company space and the emerging market space give our portfolios a difference relative to our peers. I look forward to talking more about these positions in future video updates.